Kong listing. Joining us now to talk more on China market volatility is Gary Dvorchak, Managing Director at Blueshirt Group. Gary, good to see you.
How you doing, Mike?
All right. Very, very sort of tumultuous moment here for any Chinese company listed here or hoping to list here. We have, in addition to pressure from China on the likes of Didi, you've got this law in the U.S. A lot of companies, Yum China among them, saying we may have to down the road delist from a U.S. exchange because of these auditing rules. What would you advise companies right now if they already have a listing? Is there a way around that restriction?
So a couple of things. One, Didi is a very unique situation, right? Because they're in this ongoing battle with the regulators and the Chinese government. So that's very unique. But the audit situation is really going to affect pretty much almost every Chinese company that is listed in the U.S. And I can tell you, we're talking to a lot of our clients and we talk to other companies, and they're really scratching their heads about what to do because there's really two paths forward. One is wait and see what happens. And certainly Yum China in their press release said, we hope that the law has changed. Otherwise, we may have to delist. And then others are trying to switch auditors, find a situation where a U.S. audit team could do the audit in China. There's a lot of difficulty around that, especially now with the borders being closed because of COVID. So the good thing is these companies have 3 years to sort it out. And really, I actually should say that the governments of both countries have 3 years to sort it out because it's really a political situation that's going to be decided at the national governmental level as opposed to farther down or with the companies individually.
As a practical matter, how much value is there right now in having a U.S. listing? I mean, if you could do a Hong Kong listing or something like that as a substitute, since these stocks have already been hurt so much, I just wonder if it may not be that big a further blow if they happen to just be listed elsewhere.
Well, that's a great point because a lot of the companies really don't need to be listed in the United States. Certainly, we have great capital markets. There are certain sectors where the investor knowledge is far better than anywhere else in the world. Biotech is a great example. And you saw Beijing was one of the 5 on the list yesterday, and they listed here a long time ago for that reason. Having said that, most Chinese companies probably would have more knowledgeable investors listing in Hong Kong simply because of the local knowledge, as they operate in China. So companies that are listed in the U.S., a initial move to a dual listing makes a lot of sense. And I would estimate probably the vast majority of U.S. listed companies are examining how they could do a Hong Kong listing or a Shanghai listing at this time. So that move does make sense. It's just, obviously, there's a lot of difficulty, a lot of cost around it. And this is the thing where Didi factors in, because most companies would assume if they want to list in Hong Kong, they could do it pretty easily. Today was the first situation where you have a company that they're working on plan B, right? They're going to list in Hong Kong. Now they're not able to do that. So that injects a lot of uncertainty into what is probably the plan B for the vast majority of Chinese companies traded here now.